Welcome back to EG Financials. Today we're taking a look at multiple charts from the Federal Reserve covering the real estate market. We'll take a look at home prices, supply, and home ownership rates. Starting off with median sell price of houses sold. And these are national home prices. So we can take a quick look going all the way back to the 1960s, 1950s, and we can see how the home prices have appreciated over the past few decades. Here we can see when home prices crashed after 2007. Home prices bottomed out around the first few months of 2009, and since then it's been increasing for a good solid 10 years. And then we saw a dip around 2019, and let me zoom in so we can get a better picture. And when the Federal Reserve dropped interest rates and people were getting 2.5, 3% mortgage rates, that's when the real estate market saw a huge increase. And this chart is showing that it peaked around the end of 2022 last year. And the most recent data point is for Q2 2023, and the median sell price of houses sold for this period was $416,000, a decrease from the peak where it was $479,000. Next chart is looking at real residential property prices for the United States. So anytime you see the word real, it means it's been adjusted for inflation. And these vertical bars in the graph represent recessions. And this clearly shows the cycle of the real estate market with the rest of the economy, how it tends to peak before the recession is documented. And we should see something similar for the next 6 to 12 months. Many economists are expecting a recession at the end of this year, 2023, or early next year, 2024. So this will most likely be our peak, similar to 2006. And then we'll see a gray vertical bar representing a recession. And this next report is looking at active listings in the United States. We keep hearing over and over that we have an inventory issue for the housing market. That's partly due to not building enough, and also due to the lock-in effect, where many people have a low interest rate locked in, whether it's 2.5 or 3%, and they don't have any plans of moving or selling their house because interest rates at the moment are closer to 7% or slightly higher. This chart is showing that for June 2023, there were 613,000 active listings. Just taking a high-level view, we can see at the last year or so, active listings have been a lot lower than they have been in the last few years. Once we see inventory start to increase, we might be able to expect home prices to soften, meaning they might see a slight decrease, or we'll see a decrease in home appreciation. This next chart is looking at the home ownership rate in the United States for Q2 2023. Again, that's April, May, and June 2023. About 65.9% of the population owned a home. Next, we're taking a look at real median household incomes. We can see that it's been increasing significantly since the last major recession. And this next chart is looking at household debt service payments as a percent of disposable personal income. So the lower this percentage is, the stronger financially the consumer is, which strongly supports the case that many people make where they don't expect the housing market to crash like it did back in 2007 because the consumer is in a significantly stronger position than they were back then. And this next chart is similar to the previous one, but it's only looking at mortgage debt service payments as a percentage of disposable personal income. So the previous chart was looking at all debt. This is just mortgage debt. And again, we can see that the consumer or homeowners are in a great position financially compared to previous decades. And that's it for today. Make sure you follow for more updates. We come out with weekly or daily reports depending on the data releases. So make sure you follow. Thank you.